hello everyone, and welcome to So You Want to Be an Angel Investor, FrontFundr and Fasken's joint event about the rise of retail investing. During today's session, we're going to look at what it means to be an investor in 2021, the potential rewards and also the risks, and also some do's and don'ts when it comes to assessing any potential investments. Please bear in mind as well that this is an interactive session, so we encourage you to send in any questions that you have throughout. To discuss all of these interesting and exciting topics, I'm delighted to say that we've put together an all-star panel that features Prathna Ramesh from Future Sight Ventures, Dr. Lyle Notice, serial angel investor, Julien Brault from Hard Bacon, and last, but certainly not least, our guest moderator for the day, Kate Grant from Fasken. A very warm welcome to all four of you. It's great to have you with us today. Now, before I hand over to Kate for the exciting and interesting parts, I do need to read you a quick legal disclaimer. So please note that today's event is provided for informational purposes only. All views and opinions shared by panelists are their own. They do not constitute direct advice on how to invest through FrontFundr. All users of the platform are encouraged to thoroughly review the potential risks and rewards of each investment that they're considering, and or speak to their respective legal or accounting advisors before making an investment decision. That's it from me. Kate, over to you.
Great, thank you so much. And it's really great to be here today discussing this important topic. So we're going to jump right into it and get the panel rolling. So I think the first question, and this is a question that I've gotten a lot in my career, is what is an angel investor and how do you become one?
So I can take that first. Thanks, Kate, for the lead-in, and John as well. It's a pleasure to be here. Really quick note about myself. As you mentioned, my name is Prathna. I most recently served as managing director at Maple Leaf Angels, a Toronto-based angel investor network. So this topic is very near and dear to my heart. I'll tell you a little bit about just the definition of angel investor and where that origin of it, where it came about, because that was news to me as well. So it actually came about in the times where Broadway was struggling to survive, and you had individuals, wealthy individuals, who were able to put up money to help them survive. Anyway, so that's evolved a lot over time, and the most commonly perceived definition of an angel investor today is someone that is either an accredited investor or a past entrepreneur or a business person that has accumulated some wealth in order to invest in early stage startup companies. And you typically invest as an individual, or you invest with a group of friends, or you invest as an angel investor group, or as a syndicate, or on a crowdfunding platform like FrontFundr. The core of it remains the same. You're investing in early stage startup companies. Most often they're pre-revenue, pre-traction. You're really placing a bet on the founders and the vision of how they want to build this.
That's a great answer. And I actually did not know that about angel investing, that backstory. So you learn something every day. All right, why don't we jump into our next question here? You hear a lot just going through the angel network, there's accredited and non-accredited investors. And I find there's a lot of confusion around, what does that mean? What are the thresholds? It's different between the US and Canada as well. So I think it would be good for us to talk a little bit about, what does it mean to be an accredited investor? What is a non-accredited investor? And how do you become one versus the other?
I think that's a great question. I'll jump on that there. Essentially, if you are an accredited investor, you have to have a net worth of $1 million or more, or make over 200K for a period, I think, of 2 years, or have sort of a joint, I guess you would say, salary with a spouse. So that's 300K. And I think from a state's perspective, prior to 2012, I think since probably around 1933, the law said that unless you had that type of financial profile, you couldn't invest in early stage companies. Here comes Obama at the time of 2012, and he sort of drafts this Jobs Act, the Jumpstart Our Business Sector Act. And it was the first time in American history where people who didn't have that type of net worth could now invest in early stage companies. And I think it opened the door really to now the average person could put $100 in, or $50, or $20 into an early stage company. And so before, the sort of main street investors didn't have that access. And so I think it's great. I think it's wonderful.
I'll just jump in on that point, Lyle. Completely agreed with just how things have evolved, allowing for greater accessibility and flexibility for the entrepreneurs in their fundraising. I look at this also from a securities angle, and we were just chatting about this beforehand, where the securities regulators in different areas are really focused on investor protection, right? However, I think they recognize an opportunity that comes with crowdfunding, and therefore there is an exemption that has been baked in that allows for the retail investing. And I was just getting clarity on the numbers there. The important thing, whether you're accredited, whether you're not accredited, if you're using a crowdfunding platform like FrontFundr, there are limits in terms of the amount of capital that you will be able to invest. And so I think that number is close to 10,000, but Lyle was talking about deals where he's done, where there's typically a calculation that you might go through in order to assess what's the right amount of capital you want to put in. So I think that's really important as an angel investor, no matter what form you're doing it in, assessing why you're doing it and how much of your capital you're actually allocating to this asset class.
Mm-hmm. And I think those are all very good points as well. Just kind of breaking that down, right? Can you do this? What are you putting in? And understanding risk tolerance as well. I think it would be great to talk a little bit from the startup side and hear from Julian. As a startup, what is the benefit of bringing on angels and using a platform similar to FrontFundr? I think it's very interesting the way that you've done it throughout your startup's history. So would love to dig into that a little bit and just learn some of your experiences.
Yeah, I mean, I feel there's a misconception about, the difference between like smart money, and smart money is supposed to be like someone extremely rich and extremely smart who's going to help you get to the next level. And those people exist for sure. But I would say that, there's a lot of different kind of smart money. Like we have like at Hard Bacon, and we're closing around like tomorrow. So we should close it and have probably like 1,500, investors / shareholders. A lot of those people have a unique expertise that can help us get to the next level. Some of those people don't, and that's fine. But I would say that it gives you like a huge network of people that can help you. And when you're kind of stuck, saying, oh, I don't really have this expertise, or I need to hire this, this position, but I don't know exactly like how I should draft, for example, the job offer, then I can just look in my, investor directory and see, oh, let's say it's SEO. I could find like there is people, SEO specialists that invested in Hard Bacon, and basically there's a lot of different expertise. And then you can call them, and they're really happy to help in general. Like they invested in the company, they believe in it, and also they're not as busy as a partner at a fund that have a portfolio of company that are, asking them favors, and also that needs to see all those new, entrepreneurs and try to find the rare one that's going to have an outsized return. So those people tend to be super busy, and it's hard to access them. So I would say like it gives you like a wonderful network. And also when there's a good news, we use the list and we say like, oh, could you share that? And it's also marketing. So I guess it's the same thing that VC usually will spread good news and are supposed to help as well, when someone come with a question or something. But it is just more. You have much more people, much more expertise. So in that sense, that's one of the huge advantage of doing this. The other one I would say is that raising money is always hard and really time consuming for entrepreneurs. And when you do a private round, you're going to disappear almost entirely from the operation for like 6 months. And what you do is that you're in boardrooms or now on Zoom with, various shareholders, not shareholders, like investors. But it doesn't have any other effect than you not being in the company. And when you close a round, money happening in the company. When you do a round like FrontFundr, a lot of people hear about Hard Bacon. You run ads, you reach out to larger audience. So it's also, bring business opportunities. So like when I was doing my, prospection for investors, sometimes, oh, you're not an investor, but we have this need at the bank, and let's meet. So like I have a huge, now that we're about to close, I have like this huge list of business opportunity that I just started by like, oh, we're doing this round, do you want to invest? And they were like, oh, but we might be able to give you a contract. So that's another advantage, is that the time you spend on the fundraising is also helpful for business development and also for marketing and customer acquisition. And it's hard for a traditional round, you're talking to professional VCs, so it's rare that they're going to give you a contract, for example.
Kate, I want to add to what Julian's saying. From the investor side, here's a sort of practical, personal example. So in my hand, I have Bucha Brew. I don't know if you can see it. Shout out to Kara and her team. She raised on FrontFundr twice now. She's done 2 rounds. I got in the first round. I said, man, this is a great product. I doubled down. I got in the second round. For me, I feel proud because when I go to my local Sobeys, I'm picking up Bucha Brew. And so I'm buying a product that I own. And I think it's great because I know that I'm adding to revenue and sales. And so it's like a win-win situation. But for Kara and her team, they're getting free marketing because as an owner, I'm carrying this everywhere. I'm selling to my family, my friends, and I think it's just a great cycle. It's a win-win for the investor because now you're co-owner, but also you're bringing promotion and marketing and advertising. We're like evangelists, so to speak. And so I love when companies are offering on FrontFundr, and I see it in my local store. I invested in Julian's company. I told some friends about it. Their dad got into it. And so we become the evangelists as investors for the company. And so I think it's a great win-win situation.
Yeah, and I think those are all very great points. Sorry, did you want to add something, Prasna?
Just a really quick point, if you don't mind. It was more of a question also tailored toward Julian to get a sense for, Julian, you made a distinction there about investor versus shareholder. And I think it would be important for the audience to understand if they were investing, are they coming on as a shareholder on your cap table, or are they an investor? Do they feel like an owner and all the benefits that Lyle spoke of?
So I made the distinction because the current round is through convertible notes. Obviously, a convertible notes is considered like quasi-equity because whatever even happens in the company, the notes convert into shares. But it's just, they're technically not shareholder, but they're going to get the same investors updates and the same everything. And, and those convertible are going to convert and they're going to be shareholders. So I don't see there's not a big difference, but legally there is.
Yeah, for sure. And we actually got our first question, which is kind of an interesting one to tackle at this point. How did you get started with angel investing and investing in the private markets? And what advice do you have for those that want to get started? And I think that's a great question for us to tackle right now as we're starting to go down this path.
I can jump in with my answer, and I know Lyle will have a great answer too. I first got interested actually because I was observing an angel investor. A mentor of mine was an angel investor, and we worked together in a different company. But I noticed on afternoons he would be on these really lengthy calls and it sounded like it was with entrepreneurs, and long coaching calls about different things, you know, your go-to-market strategy, how to build a sales. And I was like, wait, none of this is related to, I was kind of eavesdropping on those calls. I was like, none of these are related to the work we're doing. What's happening here? And I did see that go on for a while. And I saw that, you know, he would meet up with folks in the boardroom as well with entrepreneurs. And so I was quite intrigued. I started having conversations with him and understood, you know, so he had a day job, and then he had the fulfillment that he got from doing these activities. It just blew me away straight away. That was these informal discussions. And I was like, what are you doing really? It was just, I'm just having good conversation with these hungry founders who want to learn. And I've achieved certain things in my life, and all I'm doing is sharing my path and my journey of how I got here. And I was like, wow, that sounds great. So I went out to a Maple Leaf Angels investor meeting as a volunteer, honestly, my first time when I went out. And just the caliber of conversation that I saw in the room amongst the investors, I thought, wow, there is so much knowledge here that entrepreneurs can benefit from, and vice versa. The investors are learning a ton too, and they stay engaged and remain excited because there's a lot of hot tech that's being spoken about, and you want to be part of the next big thing. Anyway, all to say, all of these elements intrigued me quite a bit and drew me into the private capital investing world.
I think for me, the first deal I did, I got an email actually from, I think it was Microventures. It's an equity crowdfunding platform in the States. And there was a deal being offered. And so I was sort of like, should I do this? And so I pulled the trigger. I put down $3,000 in an investment called the V51 fund, Venture 51. And it was interesting because a month later, one of the companies in the fund got acquired. And so it was saying, I got an email saying, send your bank account. You know, there was an acquisition. We'll send you, you know, your what's due to you. And I thought it was a scam actually. But I confirmed, I set my account, and they transferred the money. And I was like, wait, hold on. Like, this is real? I can give money to a company and there's an exit and I get money back, there's profit. And that just set me off on a roller coaster. You know, I've done over 400 deals since then, but there's so many opportunities for the average everyday person to put in $100 or $200 or $250 and get in on the action. And I love it because it's the democratization of investing, angel investing. You're almost like a venture capitalist, and you have access to deals now that before you didn't. And so the barrier to entry is very low. It's very easy to do. Great companies like FrontFundr, they have the due diligence right there. You can look through the company, their financials, their team, Q&A, and it's so easy. And so if anyone's who's interested, hop onto FrontFundr and look through some of their deals, because I think it's a great opportunity to maybe try it. You know, put down $100 and see what happens. Maybe there's an exit. You know, a big shout out. I'm going to plug Julian right now in Hard Bacon. I invested in his company last year. And in that round, and I sent him an email, very quick with his email responses. Thank you, Julian. I was like, you know what? I'm going to double down. And so they're going public apparently this year. To me, that's a no-brainer because he's telling you we're going public. Here's an opportunity. There's going to be an exit. What that's going to look like, we don't know, but there's an exit. And so as an investor, that's what I look for personally. It's like, the company's saying in a couple of months or a year they're going public. Let me throw some cash at this, and that's just me. I'm not telling anyone to do that, but I think it's awesome that you have companies that are saying to you, invest early because we're going to have an exit pretty soon. It's almost like they're leaving breadcrumbs, and so take opportunity. And guess what? You only have a couple more hours to invest in Hard Bacon, so go for it.
That's so interesting. That almost never happens.
But the funny thing is that, like, we're not going to be the first company raising on FrontFundr to go public. Like, I think there was 3. Like, I remember, like, very good food. And there's a couple ones. I don't know the two other ones, but I think there was 3, and I was impressed. And this is very good for equity crowdfunding as a whole, because people have exit, and there's a path to use this to increase your shareholder base and basically start to do audited financial statements. I feel it's also kind of a in between, doing those kind of round between being like a private company and being a public company. So that's quite good as well for the ecosystem, because those companies, like I said, like it provides an exit and liquidity for people that invest. And I think that's what kind of have been holding back, is that it's so long that you kind of immobilize your money, that having good exits is what's going to make it more mainstream, I think.
And what's so cool about that is, you say, like they say with an exit, right? It's illiquid for maybe 5 to 7 years. And so anyone who's thinking about investing, guess what? When you put your money in, you may not see that. You kind of almost have to count it as a loss. And because it takes about 5 or 7 years for the company to exit. But with FrontFundr, for me, what I found is, in the last 2 years, Lendified had an exit. The gaming stadium had an exit. Amuka had an exit. Very Good Butcher had an exit. There's been exits coming, and this is from, I don't know, this is not typical to me, but there's been so much success with exits, and that's what you want as an investor. You either want the company to have an IPO, initial public offering, and they become public, or a merger or acquisition. And to me, the success rate within the last 2 years has been phenomenal. And another one, Pontus Water Lentils. They're on the TSX ticker symbol Hulk. I just invested with them last year, and all of a sudden they're public. I mean, this is a no-brainer for me. And now you have Hard Bacon that's about to go public. And I just think it's an amazing opportunity for the average citizen to build wealth. And so thank you, FrontFundr and companies like Hard Bacon.
Thanks a lot.
Yeah. Those are all great points. And we've actually got a couple of other timely questions that I think would be good to dig into. The first one being, what does it mean when we say have an exit, and how does that actually impact the investor? So I think that's a great question, because if you're not from this world, you probably think an exit is something you leave a door through. So would be great to hear kind of how people define that, and how does that impact your current investors?
I mean, for me, like the first time as an entrepreneur that you take outside capital, it means that you're going to have to provide some kind of exit. Like some company end up being able to buy back their shareholders, but that's the minority. So usually what an exit means, it means that you go public, and this is a minority of companies. And most of the exits are actually acquisitions. So somebody buy out the company, and then the shareholders, gets money from this acquisition. And at the end of the day, like entrepreneurs are passionate about your project; it's their baby. But when you decide to say, "Hey, I need money, and I'm gonna, dilute myself and sell some shares or convertible note or whatever instrument," it means that you need to provide an exit. And that's important, I think. For it's not for everybody. Some people they don't want that, so they shouldn't raise money. But in the context of FrontFundr, like I think it's important that you show the investors that you're realistic. When I do those calls, they ask me, it's like, what about the exit? Like, what kind of company could buy Hard Bacon? What are the possible exits? Obviously, personally, and we're in a path to do an IPO, so that's what I want to do. But if the offer is too good, we're going to take it. At the end of the day, like I have a fiduciary responsibility toward my investors. So if I feel, the risk reward equation is just, it's hard to reach the same level, staying independent, we'll accept the offer. But yeah, I mean, it's essential, because if there's no exit, there's no investors.
So the reason it's called an exit is because you exit your ownership position in that company.
And the way how I like to see it is, the angel investor is sort of doing exactly what the venture capitalist is doing. Venture capital just is institutional money and larger amounts of capital. But statistically, this is what they say, and they go by this as sort of like a rule book. 8 out of every 10 companies that they invest in will fail. They'll lose their initial capital. The 9th company may bring back sort of mediocre return, but it's the 10th company that they're looking for, because the 10th company is the moonshot. That's the one, that's the unicorn. That's the one that's going to make up for all of the other losses. And so they say in this world of angel investing, venture capital investing, you've got to have 20 to 30 great diverse companies in your portfolio, because a lot of them, to tell you the honest truth, you will lose your money. Just keeping it real. But that one unicorn or that one moonshot might bring back a 10x, a 1000x, a 5000x, and that's going to make up for all of the other losses that you may have incurred. So for me, just an example, when I invested in Very Good Butchers, my return brought back everything over my 400 investments. And so even if I stop today, I'm still up. I still won off of one investment. The beauty is that I still have 399 companies that are still working, that are still grinding away. And so that could be another unicorn. And so it's risky. It's definitely risky. They say, don't put up more than you can afford to lose. But in the risk, there's high reward. And I often look at it, I'm blabbing, I'm sorry, I could talk about this for years, but watch this. To me, it makes more sense to get in early. Everyone gets excited about the IPO. So the Airbnb IPO at $180, per share. What if you got in at $5 a share pre-IPO? Like, you think about that. You have a chance to get the shares on sale or pay full price or a premium price. And to me, it's like, I want to get in early. There's people who are getting in on the companies pre-IPO early and then selling their shares to the IPOers who get, when it goes private. So I think it's an amazing, amazing opportunity once again.
And Lyle, that's really interesting what you're saying, because also there's kind of a trend where companies go public later and later. Not, this year is kind of crazy. It's kind of the reverse. The IPO market is really hot, and you have early companies such as us and Very Good Butcher that are going public at the early stage. But if you look at the whole market, if you invested in the IPO of Microsoft, the return is just staggering. But investing in the Uber IPO, you might double your money, but you're not going to do 5,000x. They go later and later because there's more and more money in the private market. So actually, if as a retail investor you're just waiting for a company to go public, often the opportunity is kind of gone. They went. We talk about companies like Airbnb and so on, they're wonderful companies. It's just there's no way it can be valued. I don't know what's the valuation, but last time I checked was 40 or 50 billion. It's not like $1 trillion company. At some point it reached a level. So it's also if you want to have the same opportunity that your parents had in the stock market, you need to look at the private market now.
Yes.
And maybe there's a reverse of, maybe this trend of very early IPO will, and there's going to be a comeback of the clock. But for now, it's very nascent. Those usually the main path is to wait as long as possible to do the IPO, and we'll see. Maybe there's going to be a lot of opportunities in early IPOs. Time will tell.
I think those are all really great points. And we're going to answer one more audience question here because it's come up from a few people. But as an angel investor, how do you evaluate opportunities? And, what are you looking for when you're investing? Because, it's always been a saying, invest in what you know, but, great risk can also bring great reward. So how do you look at an investment and decide, yes, this is the one for me versus no, I'm going to pass on this deal?
So broadly speaking, I look at 3 major areas, your team, your product, and the market. And the order of those 3 things are really set by yourself individually, independently. There will be best practices. Each fund will have their own thesis. Each investor will have their own strategy. My opinion is you're betting so early in a company that the product barely exists or is probably going to change several times before it hits success. And so to me, number one is the people. Are these the people that are going to execute no matter what? And will they do what they say they'll do? And if things don't work out, will they be resourceful? Will they be good custodians of my capital? That's the first question. And that's a whole trust element, getting to know them, speaking as much as you can beforehand, etc., doing reference checks. Second thing is the market. Is this problem real? Is the market growing? If the market's not growing, are there some existing incumbent players that have occupied positions? Is there an opportunity for penetration? So this will be some discussions with the founder. This will be some research by yourself of competitors. And it's always good to invest. They say, lone wolf investing is one way, but you can do it as a group, and you're probably better off hearing different opinions around the table, but each to their own. So market, number two. And then number three, product. As I said, it's probably going to change, but there has to be some sort of hook at this point when you're investing. Yes, the problem's big, but is this another dog walking app? No shade at dog walking apps. I think there's certainly a need for it, but are you the same thing? Are you different are you unique in any way? So asking yourself, is there intellectual property? And when you put head to head against another company, can this company win? So that being said, I did see the question around, you don't want to just be gambling, right? That's super important. You might as well go to a casino and do this there. So there are two other things that we looked at quite diligently, and that honestly, that was diligence. Doing your due diligence is super critical. The Kaufman Institute, which is the holy grail for venture capital, private equity, early stage, they put out some stats that said that if you do less than 20 hours of due diligence, the chances of your return are probably sitting in the 1 to 2 times your capital deployed. If you do more than 40 hours of diligence, you can be in closer to the 5 to 7 times return on capital. Now that's one set of stats based on one set of data. And then the other important piece they talked about was the importance of your involvement with the company after investment. And that doesn't mean, I'm talking to Julian and I'm giving him advice every single day about what he should do on his business, but we can't lose touch for a whole year. And then, I get an update later on and then see, hey, what's happening? That's your involvement, your engagement as an investor, even through a crowdfunding platform. Your chances of success increase significantly the more involved and abreast you are of how the company is progressing.
I just want to add to what Prafna has said, and I think those points, I'll just add a couple more. I have this model that a friend gave me. It's called the 7 T's of venture capital investing. And it's basically, she said, team, total addressable market, traction, the tech, transformation, timing, and 10x. And it doesn't have to be that, but that's sort of what I go by. And I sort of underscore traction. Is there traction in the market? Where is it? I tend to sort of look at the news. I look on socials. I try to see, is this product, is it popular? Is this the next thing that's going to be in every household? And what's the total addressable market? Is it $1 billion market, or is it just a $1 million market? And so for me, I want to see that this product is popular, it's hot, it's the newest thing, that it's going to go viral. And that's kind of what I base it off of. It's probably maybe not the best, but I think if people can see the value in that product and they're willing to buy it and spend money on it and consume it, for me as an investor, that's an important thing.
Definitely, and I think those are all great points. Something I also want to touch on too is from the startup and their perspective, it's really a two-way street when you take investment. And Julian mentioned good versus bad money. And how do you make that decision whether or not to accept somebody as an investor? How do you do due diligence on your investor to know that they're going to be working for you and have your best interests?
That's a good question. I feel in the equity crowdfunding context, it's kind of different, because if you're going to have like 600, 1,000 investors, you're actually not doing a due diligence on those people. That's just the reality. So it's a little bit different. If you would do like a private round with a couple of angels, I would definitely do due diligence. And also those angels would probably want a seat on the board, and they would want some control. So usually most companies that do equity crowdfunding, they either have like a voting trust agreement to make sure that there's not some person who invested for the wrong reason that could kind of try to use their voting power to do stuff that is not in the best interest of the company or all the shareholders. So at this point, if there's a voting trust agreement, it kind of, they cannot really disrupt your business. Obviously, since we're using an offering memorandum, like FrontFundr act as a broker, and they have some kind of KYC to do, and they need to respect the anti-money laundering regulation, which is very good. I wouldn't want to have like a lot of mafia money deployed in hard bacon. That wouldn't feel great. But actually, as a company, it means that you do less due diligence. When I talk to people, if I feel there's no fit or the expectation, I won't, and that's very important, because I'll be honest, I don't do a due diligence on each investor. I do some research before a call, as in any sales call for that matter. But what I do is I want to make sure that if they're looking for if they need the money for like in 6 months, it's like, oh, when you're going to do your IPO, are you sure it's going to be, I don't know. We announced for 2021. And if you actually need all your money for buying a house in 6 months, you shouldn't invest in a startup. So that's important, because the last thing you want is to have shareholders that are unhappy, and actually can be the inverse if they're not understanding what's going on. And FrontFundr do a good job of making sure that investors know what they're doing. But as an entrepreneur, you have no incentive. Like if I realize that someone is don't understand what is this kind of investment, I try to discourage them and say, this is risky, and I cannot give financial advice, but I can say, like, if you're looking to invest your money in a safer way, there's a stock market, there, high interest savings account, there's a lot of product out there. Yeah, so that's what I can tell you. Like, you're going to get much more investors, so you want to make sure that that all the investors know what they're getting into, and they're aligned with the company. So, but you don't really do, and you can refuse an investment. Let's say that, I would recognize a name that, I know for sure in FrontFundr and spotted that is, either, dirty money or something like that. I would refuse it. But the reality is that you can't actually do like a whole due diligence on every single investor.
For sure. And I think it's something to think about too, is, how do you do that proper due diligence and look at it? So I'd actually like to switch gears for a quick moment and touch on diversity. We've got a very diverse panel here, which is amazing to see. And, when we often think of the stereotypical investor, I mean, people often joke and say, old, pale, male, and stale. TV and film has really given these visions of what an investor looks like. And I think the average investor is actually starting to change, and we're seeing more diversity in the space. But how can we help increase that diversity, and how can we bring in more people kind of under the tent of becoming an angel investor?
Firstly, let me say, Kate, wow, I love that. That's a much more elegant way of putting the state of affairs. Pale, male, stale. Did I get it? Did I miss one? Okay. Anyway, so I'll address your question. It's a good question. The stats are terrible, right? The angel networks that we were a part of in Canada, 15% roughly of our membership were women, female angel investors. In VCs and in funds, about 9% are in senior of women are in senior roles. 9% of senior roles are occupied by women, and despite that, I consistently see data being put out about how important it is to have diversity in that decision-making role, and that women, for example, I'm speaking about women in this case, are sometimes better and more holistic investors even. And I think it's a simple thing. We are amidst a movement in this regard. I think things we weren't, I don't think we're speaking about it at this scale 4 or even 7 years ago. There's communities like female funders or women in VC that are meant to encourage and educate and empower more women in the investment industry. I think as a community, we absolutely have a role in pulling each other forward and appreciating that in building a successful company, in building a successful fund, in building a productive society, you can't function ignoring 50% of the population, right? And in that same vein, that applies to who we surround ourselves with, be it as founders, as investors, as employees. So what small things that we can do to change this dynamic is actually just talking to 1 or 2 or 3 women in our network about investing, about entrepreneurship, about helping them find fulfillment in perhaps the early stage venture ecosystem using their skills. It's not that challenging a conversation, let me tell you that, having been through several. It's just a feeling I think that people need to have, that yes, all of us collectively should be doing this and making it easier, because there are positive consequences that come from it.
I just want to add to that. I think it involves, talking about it more. And it's interesting because I think the best sort of promotion is you telling somebody who knows that, oh, wow, that you did this. And so yesterday at 1 a.m., I was walking a friend through the FrontFundr sign up and investing in hard bacon. And it was because of my personal testimony, and I'm a good friend. And so I think if you just continue to tell people, a friend, an aunt, an uncle, and I think it's by word of mouth, because people will tend to sort of trust who they know. So I think it's important to continue the conversation, to share. And I think by doing that, more people will feel comfortable to take that risk and to take that chance. But it's got to have that personal touch, I feel.
So I guess I'm the pale, stale male here, and actually, I'd like to say that we're a leader in diversity, and we're not. And this is something that we know is an issue, and we're in the process of composing a board, and our board is not going to be only white males, even if when you constitute a board, you want people that had a lot of success in your industry, and it's an industry with a lot of men. There are women, and we're going to find, everybody's going to be on the board are going to be really smart and really able to help us go forward. But it's a challenge, and I just checked on FrontFundr my stats about the genders, and 86.77% of the shareholders in this current round are men, and that's and I don't know the stats for all the FrontFundr campaign. I assume mine is probably even more male dominated than other ones, because our app is about investment, and right now our user base is 70% male, 30% female, and there's no logical reason. So I think there's an opportunity for us to grow more by talking more to women, and having women in the marketing department could help being able to entice women to use the product. But another thing that I know for sure and has been studied is that women kind of have more, they're a little bit more risk averse, and I would say they're a little more rational about money. So, and right now, FrontFundr is incredible. There's a lot of really good company right now that I would like to invest in, but I just wish my salary was higher. So you can build, like Lyle, have like a hyper diversified. I don't even know how you got to 400, but right now it's possible. Like if I go back 2 years ago, like most of the company on the equity crowdfunding, they were really bad. so for one company, so how do you build this portfolio of like 10, 15, 30, or maybe 400 companies when the offer in North America is so little? So I think as you can have more diversification, and financially it's going to make much more sense, because if you do one investment and only one, it's kind of a leap of faith. Like Lai said, most of those company will go down or not provide an exit. So what is rational is actually a portfolio approach. And I feel in Canada, it's possible since 2020, because before, I feel like if you enter the market, you don't have enough good deals to fill it. So that's part of the answer. But anyway, so I definitely am not have all the answers about that, because we have our own challenge in terms of diversity to answer. Yeah, I think it's a challenge for the whole investment industry, not just crowdfunding. It's advisors that talk only to the husband, when the financial service industry as a whole have a huge diversity problem, and I don't have the clear explanation. I think as younger people get richer and so on, I think things are going to change, but there's still a long way to go.
Just to add to that very quickly, I think education is important as well. There are a lot of people who just don't know. They have no idea what equity crowdfunding is. Maybe they know about Kickstarter, but I think if we have more discussions like these, more platforms, more of an audience to share and educate, I think that's key, because once again, I think a lot of people are just unaware of this new opportunity. And so education is another piece of it.
Yeah, like I don't even like the word crowdfunding, because people think it's Kickstarter. Oh, you want like charity or something. So I try to just say like it's an investment round with more people involved. At the end of the day, I think crowdfunding is probably not the right term, because people just think about GoFundMe and Kickstarter.
And maybe that's a point of clarification too, so that those who are watching, those who are listening, that equity crowdfunding is a bit different from just regular crowdfunding or rewards-based crowdfunding. So with Kickstarter, you can give your donation and whatnot, and you'll receive a perk back. Maybe it's the minimal viable product, or a t-shirt, or a sticker. That's for something like Kickstarter. But with equity crowdfunding, you're giving an investment, and you can usually get equity in return, or a crowd safe, which I'm not too excited about, or a convertible note. But the difference between a platform like Kickstarter and FrontFundr is that Kickstarter is rewards-based, perks-based. FrontFundr is equity-based. You actually get equity. It's a priced round. You get shares in an early stage company. I think that's also important to sort of distinguish.
For sure. And I think those are all great points. And something that you actually brought up, Lyle, was around the education. And I know when I was in university, there was no course on venture investing or angel investing. So, what are some resources people can go to if they're interested in this? And how can you actually learn to become an angel investor?
Oh, that's a great question. There is a great book. I'm getting the exact name of it. It's called Fundamentals of Angel Investing. It's a short read. I'm pretty sure I have it here in my shelf that I could show you. Very, about 200 pages or so, but it goes over your approach, diversification, talks about your motivations, talks about term sheets, etc. at a high level. I could probably drop it in the Q&A if that helps.
Yeah, I think that's really great too. Like there are some books out there that are coming out. Lyle, do you want to add something?
Yeah, I'm just looking at my Kindle real quick. There's a book called Inside Secrets to Angel Investing by Karen Rands. Equity Crowdfunding Explained. There's another great one I'm going to share with you that really sort of gave me Angel Investing by David Rose is another excellent one. There's a book called, yes, this one right here really did it for me, Investing in the Next Big Thing. You can get it on Amazon.ca, but it kind of shares, listen, like equity crowdfunding is early and you have an opportunity to get in early, and it broke down everything. And so that was a great resource. It's called Investing in the Next Big Thing. And yeah, those are the books for me that kind of did it.
Another super popular podcast amongst this community is the All In podcast, which Amath, Jason, they key leaders in the space in Silicon Valley, and they just talk about different strategies, different businesses, markets growing, things like that. Good listen.
And yeah, with podcasts, just to add to that, The Confident Investor by Lisa Carmen Wang. That's been a really great one of recently that I've been listening to.
Fantastic. So we only have a couple of minutes left here in this session. Have a couple of other questions though that I think would be great to sort of cover. You know, we've all on this panel been either on the investment side or the startup side, or for some of us both even. You know, the angel ecosystem is really starting to grow in Canada, and sorry, cat on keyboard issue. Despite it that I work for a law firm, I am not a cat. But where do you think that this ecosystem can grow, and how is it headed in the future with tools like FrontFundr?
Yeah, it's a really good question, Kate, and a nice sort of pop-in guest visit from your cat. I think the asset class is evolving. Absolutely, you've identified that. There's a lot of private capital out there, and it's only increasing each year as we get through it. More and more investors, I'm finding, are starting professional funds, are starting micro funds, pre-seed funds, or just dabbling. As you know, myself and a couple of buddies were investing through an investment club that we've created. Or you're going through, you know, formal groups, and a lot of folks are doing that to build out a track record also for themselves, and you know, do this as a full-time profession eventually. You know, I think we're also seeing in Canada, specific to this country, companies like Shopify and Wattpad are just two examples of companies that have created several new angels, just repopulating the ecosystem. And so I think Canada is obviously not the Valley, but I think we're headed there. We're starting to see some successes on the global scale, which is just recirculating capital and smarts within the ecosystem. You're also seeing younger angels enter this space. You know, other folks, more diverse folks, not enough, but folks are entering because this is no longer just an old white gentleman's club, as you said before. So no doubt angel investing is certainly the new hot thing. FrontFundr for sure puts access in the hands of retail investors, makes things easy. It's complementary to a lot of what's happening. But I think the important takeaway is, you know, because of the amount of capital that's available, I think everyone is going to start to be quite a bit more selective, be it founders in terms of who they're taking capital from, and investors in terms of where they're putting their money. And so all to say, you know, it's probably not the best idea to be doing anything you're doing for the sake of, or blindly following, or, you know, gambling. That might work best for you, but it's always better, I think, to have an approach, to be strategic about it, and to think competitively, be it in what you're investing in, or just what you're spending your time with.
I want to add to that. I was in a clubhouse room with Jason Calacanis, a great angel from Silicon Valley. He's got a really great book out, by the way, Angel. I asked him specifically, I said, do you think equity crowdfunding will disrupt the VC space? And he said, he thought that it might, with so much capital now coming from the crowd. And I like to look at it like this. We might see more startups going the equity crowdfunding route and maybe not even have to do a series A and B and C and get that institutional money. Who knows? Because I think because of the pandemic, people have said that usually the traditional VCs, let's say in Silicon Valley, they like to meet in person and see the founders. But with the pandemic, it's so easy for companies and startups to raise from the crowd online because people can just invest via their computer. They don't need to meet the founders. So I often wonder if this space is going to continue to grow. I think it's still early, and I think it might disrupt the VC route. And I hear a lot of founders say, sometimes it's stressful getting that VC money because there's a lot of pressure. They want you to perform. And sometimes I've even seen founders get voted out of their board seat, like their own company, because there's so much pressure to get that exit. And when I talk to them, they're saying crowdfunding's a little bit easier from that perspective. So I just wonder if 5-10 years from now, the next Uber is going to come from the crowd. It's going to come from FrontFundr, and I'm excited about that.
I think, Lyle, you're totally right. And the retail investor in 2021 is more powerful than ever. Like we've seen it, maybe not for the GameStop story is not like an example of the smartest thing retail investor can do. But it's really signaled to the establishment that retail can have a huge impact. And we've seen like on the stock market, like a huge amount of new people that never invested before made their first stock investment. And I don't think this generation is dumber than the previous generation. I think it's the inverse. They do stupid things like all young people do. They learn from it, and there's so much information available right now. So you get hurt, and the whole generation started to invest in the end of 90s, and those are the gray hair portfolio managers today, and they probably did stupid things in the 90s. So there's that, like on the stock market. So retail is more important than it never have been, and even the ER firm are kind of changing. It used to be like a game of like calling people in the institution. Right now, you need to do digital marketing to support the stock. So that's a new thing. And I think the dynamic in the private market is just the same. I mean, it used to be that the retail investor had no space. You couldn't do anything. Right now, they can, finance some companies, have impacts. Like Hardbacon is, we had the only institutional check we have is, I think it was 25,000. So we're really a equity crowdfunded company. I think it's gonna go in increasing. Like we see in Europe with Crowdcube and the great, crowdfunding campaign. They do huge campaign. Like, sometimes they raise $10 million in 24 hours. They don't need to do a series A. They don't need to knock at the door. In Canada, it's still nascent. I don't think there is like a truly like $10 million that all come from the crowd campaign. Sometimes FrontFundr, although to do hybrid rounds, so there's an angel and institutional round, they put the number in the campaign and then they top it off with more investors. But Hardbacon has proven that we can do like a whole round entirely in FrontFundr. So I think it's going to be, it's going to increase in importance. Is it the end for the traditional, financial service market? I don't think so, but I think retail just have more power and more voice.
I predict that Hardbacon is going to be the next unicorn, billion-dollar company coming straight from the crowd from FrontFundr.
That would be great. That's the plan, but I feel too shy to say it.
Well, we can all cross our fingers for you, Julian. I think we are exactly at time at 3 o'clock. So I wanted to thank Lyle, Julian, and Prathna for joining us today. I think it's been a great session. If there's any parting thoughts that you would like to leave with the audience, feel free to do so now. But it's been great having everyone tune in, and thank you for all of the engaging questions.
Thanks, Kate. That was really awesome. I enjoyed the discussion with Lyle and yourself and Julian. Parting wisdom, last thoughts. The only thing I'd say is think about it a little bit more. You're obviously here. You're hearing, from 3 or 4 of us. Take some time and think about why you might be interested in angel investing. I like this post by Alex Danko on the social subsidy of angel investing and how investors in the Silicon Valley operate, because that's really where I think some of this was born. And he talks about people doing it there for FOMO. You don't want to be missing out. You want to be the one that got in, when they were a small company, and you bet on them. So think about that. Think about your social standing, and a lot of people do it to stay relevant as well. And so you have that, and then you're doing it for financial returns, or you're doing it because you passionately believe in the companies. And so your answer is probably a combination of those, but it's worth spending some time on.
Yeah, I think I'll add to that by saying, I heard this sort of statement. If you had invested $100 in Facebook pre-IPO at a $5 million valuation, by the time it went public and years later for over billions of dollars, you would have made maybe somewhere with dilution in the area of $220,000. And I like to quote sort of Kendrick, who's the CEO of Republic, who says, right now, the next Fortune 500 companies are being built from the ground up through equity crowdfunding. And so you have access to be a part of this new revolution that's disrupting angel investing. The average investor, you have an opportunity through FrontFundr to be a part of that. And so, yeah, it's risky, but if you want those rewards, you got to stick to the wicket, because the runs will come.
Yeah, as an entrepreneur, and first, thank you so much, Kate, for being a wonderful host today. But what I would like to give the angels in the room in mind is, yes, do your due diligence, like Pretna said you should do, but also think about like what you can bring to the companies. And this, you're not investing in the stock market, you're investing, even if it's $500 or $50,000, you're investing in startups, and think about like what you can offer them, and reach out to them. If someone have an expertise and they're like, oh, I have like a great idea, I can make you an intro. Usually I'm like, I pick up the phone, and worst case scenario is like, I don't need this intro because X or Y. And yeah, like just think about what you can bring to the company. Those are the best investor you can have, rather than, and especially like when a founder do equity crowdfunding and they have 1,000 shareholder, so it sucks when someone's like, oh, like when is the last investor update? And then you like, oh, you're not on the list. You check, it was sent to you. So like, be diligent. If you don't receive, information, you can ask the company, but we don't have like such a big investor relationship department as a public company. So try to see yourself as part of the team, and try not to overload, the company with requests, and see what you can do to help them.
I think that's all great advice. And thank you again, everyone in the audience, as well as the panelists, for joining us today.